Welcome back. You have an intro, do you?
Finance Conference Canton Schwyz, presented by the following main sponsors: UBS, Interaction, Swiss Life Asset Managers, Ernst & Young, Drooms, Novus Partners, and the following co-sponsors: Schweizer Kantonalbank, Wirtschaftsförderung Höfe, Matic Suter & Partner, Business Network Club Zürichsee, Marketing Business Center, a company of Regus Group, Etzel Real Estate.
Hello, and welcome back. Thank you very much. We're going to continue after this lovely lunch with David Soanes, who is the Global Head of Financial Institutions Group at UBS. David is one of a rare breed that seems to have had and held has held his whole career in one institution. At the time, it was called Swiss Bank Corporation. He started there in 1991, worked his way through the debt capital markets, followed with the global capital markets, worked internationally. He was then appointed deputy head of global capital markets and global head of global it goes on, there's quite a lot, sorry about that, lots of acronyms. But he's the man. So he'll be talking to us about banking regulation and capital markets. We've heard a lot about that this morning already. I'm sure his insights will be crucial. I also heard from him that he participated in the acquisition of Lloyds and RBS at the time with the English government, so very interesting matters, which I'm sure will be very relevant. Let's give him a warm welcome. Thank you.
Well, thank you very much indeed for having me here, and I'm very pleased to be here, and I'm very pleased to be representing UBS, for whom I have indeed been working for half my life so far. And I did join Swiss Bank Corporation back in 1991. And actually, a Swiss conference was created one of my formative experiences, in that I was only 2 or 3 weeks into my job. And I was walking across the dealing floor, and I saw a phone ringing, and it was about 9 o'clock at night, and I didn't pay any attention to it, and it kept ringing and kept ringing and kept ringing. So after a while, I made the foolish decision to pick up the phone and say, Swiss Bank, or Schweizerische Bankverein, whatever it was that we said in those days. Actually, it was Swiss Bank. And the person said, listen, I need this, I need that, I need another. I'm presenting at a conference tomorrow in Switzerland, and I need all these things. And I was like, well, that's very interesting, but you know, I've just picked up the phone to be polite. I can pass on a message. He said, no, you don't understand. I am. And he gave me his name, and I knew who it was. And he told me his position. And I said, well, I'm sorry, I can't help you. And he said, do you know who I am? I said, yes. Do you know who I am? And he said, no. So I put the phone down. And I've never answered that phone ever since. I'm very pleased to tell that story, because he doesn't live too far from here, actually. So it's a very important day, and the subject I want to drill into in some detail is, I think, very relevant to what's going to happen tonight at around about 8 o'clock Swiss time, 8:30 Swiss time, with both the Fed press release and also the Fed Q&A press conference. Not just about the taper, which is very significant, but I think well baked into markets, but also around their outlook for economic growth, because there's a chance that in their outlook for economic growth will be buried in there a very, very substantial rise in interest rates in the future. And I want to bear that in mind whilst I go through a particular detail around the regulatory environment in which banks like my own, investment banks, are currently trading. The financial crisis has led to an enormous number of changes to the regulatory environment in response to the fact that there was clearly not enough capital in the system. Leverage was too high, complexity was too high, and bank managements were found wanting as to their understanding of A, their business, and B, the emergency procedures in the event that that business started to accelerate towards the floor. A lot of these changes, the regulatory changes, are absolutely required, and they are definitely created today a much safer system. There is an awful lot more capital in the system, and there are some fundamental business changes occurred. I would say that UBS is a good example of a bank that has had to change itself to reflect its past mistakes, but also to reflect its new regulatory environment, and to, frankly, become a more simple organization. And a lot of those changes are somewhat driven by the board of directors, some of it driven by the executive, a lot driven by regulation and the regulators' will. But overall, I think the overall picture of what UBS is doing is a good case study for what I believe many in the industry will actually go through, which is to reduce the amount of risk that they run, and most importantly, reduce the amount of complexity, which feeds into all sorts of other issues around IT, staff, and everything else, which is an important part of the change that banks are going through. So I hope this button works. It does. So I'm going to ask a few questions of which there is no answer required. But I'm asking you, what is this? What is this, and when was this? And then the final bit, what is this at the end? I know it doesn't look like the picture's working, but it is. If I put a little bit of a hint on there, you'll see that actually what I'm showing you is something to do with interest rates. And on the first side there, on the left, you can see there are little quarter point increments in interest rates. That's the scale of those things which are going up. And actually it ends off there with a massive 0.75%. I mean, could you imagine that today? And that's the Fed funds rate changing. And this is 1994, February 1994. And if we go through to the other one, literally the Fed tightened in 25 basis point increments every month, or every meeting, which is every month pretty much, until it got ahead of the curve, is the word. And you can see that right at the end there, you've got a picture where Fed funds have done nothing for quite some time, and indeed the 2-year note, which is what I was showing you, has done nothing for quite some time. So it was February the 4th, 1994, when interest rates had a significant directional change. This was the Fed raising rates. Everybody knew it was going to. I remember that night. Everyone knew it, and the market completely fell out. The market completely fell out of bed. In 1994, the bond lost a large amount of price. Its yield rose well above 8%. I think it might even have touched 8.5%. And you can see that the 2-year note went from 4 to close to 8% in just about 6 months to 8 months. Quite volatile. And then we had the great bull market of the internet story, and then that burst, and the Fed eased very aggressively through 01, 02, 03, and then tried to sort of get it back again as it realized that there was a great monetary inflation going on between 03 and 08, as banks began to really seriously leverage up their capital with the formation of various new types of capital market instruments like mortgage securitizations, which the technology was becoming greater and greater to allow less and less capital to support these enormous leveraged positions. And as you can see, we had a very, very sharp reversal in interest rates all the way down to January 2009. So we're sitting now at a moment when rates are really exceptionally low in the official market, i.e. the intervened market, the Fed funds market. The UK interest rate is still 0.5%. We all know what the ECB is. And it is a moment of questioning what happens when interest rates do indeed change direction. And I'm not talking about the peculiarities of the Swiss capital market and the Swiss interest rate environment, but really about the Fed and what that will do globally. So moving the discussion on a bit, I wondered if anyone could guess what this is. It looks very beautiful. It could be San Gimignano, which I hope you've been to. It's got 7 towers after a building craze that went wrong in 1650, something like that. The middle tower there looks a bit like the Burj Khalifa in Dubai, the tallest building in the world. But you'll be surprised to know that it's not. And I've got another one here. What's this? This could be the build-up from sort of First Avenue up to Fifth Avenue in New York City, I suppose. But it's none of those things. What it is what I've done there is I've taken that original graph, which was the 2-year note, the 2-year treasury, a very low volatility asset, and I've taken the 99th percentile on a 10-day moving average. And that is the fundamental building block of trading book capital. Trading book capital is driven by a requirement to have enough fat on your back that you can cope with that 99th percentile move, i.e. the most extreme move in a 1 in 100 event on a 10-day moving average. And this chart is, oh, that's very clever. This chart is interesting for a few things, in that the period August 93 to August 99, that's reasonably low volatility. There wasn't a huge amount of speculative investment banking, prop trading going on during that period of time. But when interest rates changed, there was a little bit of volatility. But frankly speaking, given the surge in interest rates, vol remained reasonably low. When interest rates changed again to cope with the fallout of the sort of tech bubble bursting, there was a little bit more volatility. But then we then get to the period of the financial crisis, and you can see that that very fat tail is important, because the size of these tails, the height of them is demonstrative of how volatile it is, but the width of the tail is how long did that volatility last. Now what that means is that in that year, middle of, start of 08 to 09, every single 10-day period was volatile. The market was all over the place in that period. And it coincides with a time when dealer capital started to dry up, and I'll come on to why. But dealers started to find that capital was becoming more expensive and they needed more of it to support the same positions. And actually we've moved into quite a capital famine period now. And in a capital famine period, I'll argue that actually asset prices should be more volatile. But the 2-year note is not, and the reason the 2-year note is not is that we have quantitative easing, and clearly there's been an enormous purchaser of treasury assets, which has driven down the volatility of that asset. Now, why is this important? Well, what's important about this is that the way that banks calculated their trading book capital and their basic capital they needed to be in business is they took a view on their VAR, their value at risk, and it was based off this. And it was done on a 2-year view. So over a 2-year period, you'd look back and say, well, how volatile has this been? What's the peak? Well, the peak in January, in the middle of 01, is this, and that's going to be the basis of my trading book VAR. And as I reach forward 2 years, if I get to January 04, my trading book VAR just goes back 2 years, and I start to drop that period out. And you can see that over a long period of time of low volatility, what happened was that dealers had to hold less and less capital against their positions. In fact, if you had an asset which had almost no volatility under a trading book VaR calculation, you'd end up holding no capital because it was not volatile. And the best example of that is probably mortgage-backed securities. So mortgage-backed securities, which maybe started the decade trading at LIBOR plus 45, ended the decade trading at LIBOR plus, ended 07, trading at around about LIBOR plus 9, and they hadn't budged from that for 2 years. And LIBOR plus 9 stayed for 2 years. There's no volatility in that asset, no capital. So trading book models were throwing off less and less capital required to hold that asset. Now, you could argue the asset should have increased in price, but actually we just made more of it. We made more AAA notes traded at LIBOR plus 9. Unfortunately, they weren't AAA. They had a bit of subprime in them. And it was that commingling of good assets and bad assets which obviously led to an enormous loss of confidence in the transparency of markets. But one of the reasons why it was able to get done is because of this effect I'm talking about here. The effect of trying to stabilize an asset class because it reduced the amount of capital required to hold against it. And indeed, the minute, the second, the day that capital is, that an asset becomes volatile, the model immediately shows you need to hold more capital. And it's not just a one-for-one, it's a multiplied effect. So the point I'm trying to make here is that the 2-year note, reasonably stable, this is a proxy for the amount of capital. And if you don't add something else to this risk-based capital model way of calculating capital, you will end up holding almost no capital if an asset reaches a low volatility. And that was an enormous mistake in the way that banks were capitalized in their trading books. As a reminder then, and I know that this might seem like ancient history, but Basel I and Basel II, the way that trading books were really put together and capitalized is they were capitalized for generic market moves, swap rates move, government bonds move. There were specific risks, i.e. a credit spread of a particular issuer. And then we also added on another risk that the obligor would default. Now that was like a default. It wasn't including, and this was a vitally important mistake, it wasn't including trading ratings migration. And ratings migration was an enormous miss from these models. So Basel 2.5, I'm not sure that many people really know Basel 2.5 off the tip of the tongue, but Basel 2.5 was like the emergency room medicine that was applied to the industry only in January 13 this year to try and correct the mistakes of Basel I and Basel II. So you take the VaR that you had before and you add to it a stressed VaR. And this stressed VaR never goes away. It doesn't matter how stable an asset is, it will never disappear. It will permanently taint that asset from a capital perspective. From a regulatory perspective, it puts a floor under trading book capital, which is good. As I said at the start, there was clearly not enough capital in the system when the financial crisis struck. And indeed, it was the very rules that allowed so little capital to be used that drove the final leg of speculation, you could argue. But this stressed VaR solves that. And it doesn't matter, you always have to have an extra level of VaR. And importantly, they also added that there was now ratings migration, an extra charge for ratings migration. Now, to try and give you a measurable impact on this, the correlation trading book that most banks ran, the level of capital required to back a correlation trading book using the new methods that run Basel 2.5 approximately increased capital by 20 times. So if you thought you had a profitable business employing $1 of capital to earn $5 of revenue, suddenly you were employing $20 of capital to earn $5 of revenue. Tremendous change in the profitability of the business. Clearly the business wasn't profitable before, but the economics made it look like it was. So just going back to this point on the 2-year note, when you look at the stressed VAR component that I've just talked about, that will then be permanently added to the 2-year note. And this is an important point, because the propensity of traders and the market to provide liquidity to this asset has just gone down. If I have to hold more capital against it, I will hold less of it. And if the market has a volatile period, I will make a bigger bid-offer spread in my market making. I will be less willing to intermediate the client flow in and out. And therefore, I would say that on the way down, as asset prices fall under any particular circumstance, dealers will be less able and less willing to catch the market on the way down. So I think you'll have more volatility on the way down. Equally, though, in the past, dealers would catch this knife. It was part of the market structure, and they'd be letting it go a bit on the way up. So you'd have a less on the way down, but equally on the way up, dealers would be unloading the inventory that they'd accumulated on the way down. That's the way that markets were being smoothed or enacted. So I think we're going to have more volatility. Clearly, more volatility drives more capital, which means dealers hold even less capital. In terms of the Basel 2.5 impacts, this is a 3 to 4-fold increase in the risk weighting of trading book risk. But on top of that, banks have to hold now 10% of core equity tier 1. UBS is electing to hold 13% of core equity tier 1. Suppose we held 4% pre-crisis, we now hold 12 actually. That's 3 times. Our trading book is up by 4, so that's 12 times the capital on our standard positions. This is why UBS is changing. This is why we are no longer going to be able to provide the same liquidity to every single asset class, but we will indeed provide liquidity to asset classes where we think we can make a difference. I want to talk about some specific assets, 3 specific assets. Italy. This movement in the Italian government bond on the 8th of August, it rallied very significantly. That night, there was an immediate requirement to reduce your Italian risk, because that night, trading book capital charge had gone up a lot. I'll come on to what it was. Importantly on here, as well as another event I'd like just to mention, because it's particular to Switzerland. As you'll know, the Swiss National Bank very successfully intervened in September of 11 to floor the Euro-Swiss rate at 120. Now, this was fine, but what it did was it meant that the hedge that most market participants had on against the euro crisis at the time, i.e. long Swiss, short whatever else, went away. So people were forced to sell something else. And the thing that they sold was Italian paper. And the effect of the Swiss-euro lock was that Italian paper got sold. And this crisis straight after that, some of it was down to this knee-jerk reaction coming out of an otherwise understandable policy. I want to talk about intraday gold. This gold, 2-day falling gold, big effect on gold and how much capital have to be held. And indeed, the intraday Nikkei, these are very sizable falls, 10% fall of a globally relevant stock market, enormous falls, and has huge long-term, irredeemable impact on the liquidity of these markets. So just in the Nikkei, you can see that between 2002 and 2008, there was a 40% increase in capital. This last period will have increased the amount of capital required to be held against the trading book Nikkei by 15 times. And it never goes away. So expect the Nikkei to be more volatile, less liquid going forward. The side effect of this was that dealers that night had to find capital because they had to post it against the Nikkei book. So what did they do? They reduced the asset they could. They sold JGBs. JGBs had been like asset-backed securities, trading like this. Very little capital, very little vol. Suddenly you spike JGBs, they need more capital. And so on and so on and so forth. Gold, it's a 300% increase in the amount of capital held as a consequence of the volatility we've seen in gold. Up or down, it doesn't matter. And Italian 10-year bonds, this is just to sort of prove the point, but there's been a very substantial spike. And it's not just in Italian 10-year bonds that we have this effect, but we have a very substantial capital squeeze going on. The point of my speech was really to try and open a little debate about the fact that Basel 2.5 has been very successful in reducing the amount of leverage in the system. It's been very successful in increasing the capital that's required to back risks that exist. But there's going to be a transition period in which the market participants and dealers get used to the idea of this instant feedback. And that first response is to make things more volatile. So it's a pro-cyclical response rather than something which would be more stabilizing. I don't think there's necessarily a better way of doing it, but it's certainly worth knowing about it. And if we go back, if you think back to what I started with, which is when interest rates rise, in the past, dealers were there to stabilize some of that. If you wanted to sell $2 billion of 10-year notes, 5 dealers would take that from you. It won't be the case this time. When rates move next time, and it could be tonight, it could be in the next 3 weeks, 6 weeks, you'll be much more on your own than before. And that's what I wanted to say. Thank you very much.
You told me that time was of the essence. Do you have time to take one question?
I'll take a quick question.
Do we have any questions on this very interesting insight into interest rates and debt ratios? No banker facing any? Yes, we have a few. There we go.
Thought I might get away with it then.
For the purpose of this audience, could you tell us what your analysis of those 99% price movement would be for the German Bund, the 10-year contract, and what you think would apply in the case of German banks if you have moves in that instrument and the likely repercussion for the rest of the Eurozone?
Well, I don't know off the top of my head the 99th percentile data for bunds. It will clearly be a lot lower than the more volatile series like Italy and Spain. But it certainly has seen volatility just by nature of the interest rate rise we've seen in the last few days. I'm not saying that the liquidity of the German market actually is going to be that affected because of its safe haven status within this whole story. But what that means really is that the amount of capital designated to trade Germany probably doesn't come down. And if it has to go up, it goes up and people put more into it. So UBS, we absolutely trade Germany. And if we need to find more capital, we'll find more capital. But it means the peripheral markets, the periphery, that's where that capital will come from. So I think Germany, the implication for Germany of a sudden rise in interest rates is, there'll be a period of volatility and the market may not be perfect, but I think there'll be a very functioning market. But I don't think that will necessarily be the case of markets where who have to be starved of capital in order to find the capital support. Germany, UK, US. So you can see that the amount of capital held against US Treasuries has gone up, and I believe dealers are not finding it all. I mean, bid-offer spreads in the US Treasury market have increased, but they're finding some of it. So the drought applies elsewhere. It applies to equity prices, equity markets. It applies to FX. It applies everywhere. But the real core risk-free, if that's the right word, actually, ironically, their liquidity it will be difficult to discern too much of a difference.
Any last question? Otherwise, I think you need to go anyways. So good luck with your journey. Thank you very much.
Thank you very much.
Please accept the gift as well. Thank you. Bye-bye. Take care. Cheers. Moving on swiftly to a talk on the future of finance. Clearly an ambitious topic, very related to all the topics we've already heard about this morning. Dr. Peter Kura is going to address it and I'm sure make it very interesting. His background, well, he was trained as a lawyer. He joined the bar in Zurich in 1980. He worked for Baker & McKenzie and Homburger, famous law firms, one international, one more local, specializing in M&A and